behind this drive for this GCC debt? Because in spite of all of the turmoil we've seen in this region over the last several years and the dip in oil prices that we saw majorly impacting these Gulf economies, it seems as if people can't get enough of the debt in this part of the world.
That's right. And there are several factors accounting for that. One is obviously there is 13 trillion worth of bonds out there which are giving negative yield. So there is a yield chase in this part of the world. Emerging market all bonds are in demand, and GCC being higher rated is particularly in demand. Because while GCC bonds are better rated than the emerging markets, the yield on them at roughly an average of 3.52% is actually quite solid. So it's the yield chase. The second thing is GCC bonds are being included in the JP Morgan MBIG index. So a lot of fund managers who follow that are buying GCC bonds. The third thing supporting the bid for GCC is basically the increasing prospect of oil prices to remain above the $60-65 per barrel mark. As long as oil remains above that, obviously the economies here will probably keep doing well, and the government's coffers would be deep enough. So that oil stability is also helping GCC bonds. The fourth point is basically, while there are geopolitical concerns around, the overall underlying economies are likely to do better this year than the previous 2 years, and that supports the bid for GCC bonds.
That's definitely something that most folks more globally don't seem to get in terms of those Gulf tensions, and essentially the Gulf bonds actually gained in June in spite of all of the tensions that we saw and all of the running around that I did between here and Fujairah. But I want to mention the Public Investment Fund, because last week I was talking to the executive director of the PIF, and we were talking about the options for them to raise debt over the coming months and how interested they were in doing that. Walk us through the base case scenario for what's going to happen next from their side and the interest you see for Public Investment Fund debt.
So we don't cover Public Investment Fund in any detail, but given that PIF has big ambitions of increasing its asset under management and it is on an investment spree, the chances are that they would fund part of that from equity and part of that from debt, and at some stage may come to the debt market. But I think right now we are hearing more talks about PIF taking money from the syndicated bank loan market. Yeah? So as and when they come, given that it's owned by the government, the chances are it will get very strong reception.
Right. Your underlying logic that's driving demand for GCC bonds, Anita, is higher oil price expectations. What are you really foreseeing in the oil market, given that one believes the upside is capped with U.S. supplies coming in pretty much every single day, offsetting the potential of oil prices moving higher from here?
So our in-house forecast for oil prices is actually that towards the mid 2020 or later, oil prices will actually fall from where we are right now. So it's not about higher oil prices going higher, but it is more about high oil prices remaining above the previous assumption that was used for the budget planning by these 6 GCC countries. It was more in the range of $55 to $60 per barrel, and looks like oil will remain above that. So when I said higher oil prices, it was more higher than the budget assumptions, not necessarily higher than where we are today. You are very right that the increasing production from American shale region and the fact that trade war related sentiment is dampening investment and global growth, and that may reduce demand for oil, all those things are playing their part, and which is why, despite the concerns about some geopolitical risk in the region, oil price hasn't increased materially. So we are very range bound in the 60 to 70 area, and I think they will probably, our in-house view is it will fluctuate to somewhere between 60 to 75 range. Yeah.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.